So this is the journal ledger. We have account receivable, and in account receivable we have, for example, a company have 3 customers: Mr. Brown, FedEx, and Moody's, right? But account receivable is showing you 9,000. It won't show you that 9,000 belong to which customers. So you need to double click in accounting software. You need to double click, and it will open these subsidiary accounts, right? We call these subsidiary accounts. And subsidiary accounts of which account? Account receivable. These are the like mini accounts of the total account receivable account. Okay, everybody understand that? Junpyo, Ping Ping, Sipade, Chloe, Arone, Ajim, David. Understand?
I think I understood.
Okay, let's move forward. So, what are the notes receivables? Like I told you, so there is a borrower who signs a written promise to pay the lender a definite sum plus the interest, and there's a maturity date as well. After 90 days, 1 year, 6 months, whatsoever. So it may require borrower to pledge security as well. So you are giving or lending money to others, and you have what? Nothing. So that is a foolish move. You must have some kind of security. Security can be in the name of business. So you make the agreement on business letter, on a letter pad. So it can be challengeable by court, or you can sign on some court papers. We call this stamp paper. Which can be challengeable, or which can be challenged through court, so that you have some kind of security. Or you can have some kind of documents, business documents, property documents, or maybe some gold, right? This kind of stuff, you must have some kind of security, so that if the borrower, he fails to pay you or refuses to pay you, you must have something to challenge, or must have some backup so that you can sell that and recover your amount. So other receivables, so they are miscellaneous category. For example, interest receivable and advances to employees. What do we mean by this advances to employees? For example, the employee is working for you from 10 years, and you trust that employees, its salary is it's like handsome, and this employee wants to build a house, and he applied a loan. Rather he go to the bank, he apply loan from the business, and you grant them loan, right? This is also called other receivables. So every month you deduct some portion from his salary as loan that you paid to him, right? So this is called other receivable. Mostly we created a miscellaneous category, and we account for that. So internal control over cash collection on the account. Since account receivable also include cash, right? Cash. So there must be some kind of control. So we talked about internal cash controls over when we talk about how to account for cash. So in our previous lecture, we talked about that. So for example, when credit sale occur, what is the entry? Account receivable to cash, right? Sorry, sales, account receivable to sales, my bad. So remember, this account receivable must give you cash back. When it gives you cash, entry would be account receivable to, cash to account receivable. It means cash is involved. When cash is involved, there must be internal control over there. Otherwise, there are chances for fraud as well. Maybe employee receive on customer behalf, but that employee put that cash into his own pocket and do not submit that cash into company's account. So we must have some kind of control. So separate cash handling and cash accounting duties. So those who receive the cash, they are different from those who make accounting entries, right? So bookkeepers or accountant must not handle the cash. They just record the entries. That's it. So separate employees should open incoming mails and make deposits. So that employee who's responsible to receive cash, he receives cash and deposit to the bank, and that receipt that he received from the bank, he deposit to the accounting department, and that accounting department basically they try to record the transaction. Okay, we received the cash from this customer and we are making the entry, this entry. The lockbox system is like that. You know, you receive the amount, you as soon as you receive the amount, you deposit to the bank, and that system is called basically lockbox system. Okay, now the guidelines regarding managing receivable. So, what are the benefits and the cost of extending credits to customers? Number one, increase in sales. And the risk or the cost are that not collecting the amount or not collecting the expected amount that we expect from the customer. Maybe he paid us 60% and 40% he said, I cannot pay you. So run a credit check on prospective customer. What are the plan of actions here? Extend credit only to a credit worthy customers. It's not like that a new customer come and say, I'm going to pay you after 90 days. And then surely you would say that your request we are going to turn down. Why? Because you don't have any established credit history from us, right? We can only allow you some kind of credit if you have some kind of history of purchasing from us. So time to time in business, you develop some kind of relationships and trustworthiness, creditworthiness. On the basis of that, you allow this credit. So design the internal control system to separate duties. How are you going to do that? Separate handling, cash handling, personnel, and accounting duties to keep employees from stealing the cash collected from the customers, right? And the issues that we need to address here, keep a close eye on customer payment habits as well. Send second and third statement to slow paying customers if necessary. Basically, pursue collection from customer to maximize cash flow. So it's normal business routine or it's normal, human nature that they remember that, they need to receive money, but sometimes or most of the time they forget to pay. This is human nature. Among your, classmates as well, they remember that this person need to pay us, but they forget sometimes, or it's human nature that I need to pay him as well. So it's business routine that you send them reminder, so in the form of emails, messages, alerts, or some letters as well. Even then they don't respond to that one, then you go for legal actions. So issues, measure and report receivable on the balance sheet at net realizable value. What does it mean? It means 1,000 are the receivables, and we expect that $80 gonna be not received from the customer. They are going to be a bad debt. So some books mention uncollectible accounts as bad debts. So don't be confused if I use the word bad debts more often, it means uncollectible accounts. So now the question is why to set up this allowance for uncollectible account? Why we are deliberately decreasing the amount of assets? So remember or recall, let me blackboard here. So assets is equal to balance sheet equation liabilities plus honest equity. So we want more assets. More asset means good job, but we are trying to write it down less amount of accounts receivable. We are writing down accounts receivable as accounts receivable number less its reserve or allowances and this amount of going to be called that net realizable value NRV. That is of course less from this amount. So why we are showing our asset less? That question must pop up in your mind. Why we are doing that? It's because if you are a smart manager, then one of your duty is to plan as well. So planning involves forecasting, right? And mostly we do forecasting in, we completed cash budgeting in our last lecture in which we talk about what are the plannings. So you forecast that 1,000 is your account receivable, and by forecasting, when you make cash budget, you need to write it down cash collected from customers. If you're not a smart manager, you write it down that cash going to be collected in 30 days, 1,000 from customers. And when 30 days happen and what happened, you only receive 900. So your planning is disturbed. When your planning is disturbed, maybe you apply at the end for credit from the bank account because you mentioned that in that after 30 days you mentioned that you are going to have surplus, so you didn't apply for. You don't need to apply a bank loan. What happened due to this 100? You have a shortage of the cash, and on emergency basis you apply loan from the bank, and that interest going to be higher at higher rate. So your planning is disturbed. So a smart manager, they